Hello, thank you everyone. Welcome to another installment of our Help for Homeowners series put on by the Department of Consumer and Business Affairs and our foreclosure prevention unit. My name is Samuel Lakeen, and my co-host Ann Miller will discuss the purposes and advantages an impound account gives to a property owner. We will discuss certain rules and limitations of impound accounts, as well as timelines of disbursements made throughout the year. As always, our webinars are recorded and posted online at our website. If you are unable to attend or you would like to view the rest of our webinars, please visit us at dcba.lacounty.gov/foreclosure-prevention-webinars. As always, we will have time for questions at the end of the presentation. Please utilize the chat box to submit any questions or comments that will be addressed at the end. Now, the mission for the Department of Consumer and Business Affairs is to promote a fair and vibrant marketplace. We serve consumers, businesses, and communities through education, advocacy, and complaint resolution. The department has been serving Los Angeles County consumers and businesses since 1976. Again, my name is Samuel Lakeen. I am a foreclosure prevention counselor with the unit. My co-host Ann Miller is also a foreclosure prevention counselor with the unit. If you wanted to reach out to our department via email concerning this webinar or any other questions you might have related to foreclosure, you could email us at homehelp@dcba.lacounty.gov. Our website is dcba.lacounty.gov, where you can also find some more information, or you could reach out to us by phone at 833-238-4450. Now, what is an actual impound account? Now, an impound mortgage account, sometimes referred to or called an escrow account, is actually set up by your mortgage lender or your servicer to pay specific property-related expenses. Now, these expenses are added up and paid with your normal monthly loan payments. Typically, when somebody's going to look at a breakdown of their monthly payment to their mortgage company, it's going to be broken down into 4, sometimes 5 different sections. PITI, that's why I say sometimes pay. P would stand for principal, meaning the amount of your monthly payment that is applied to your principal balance. The first I would be applied to stand for interest, meaning the interest that's paid towards your loan. The second would be property tax. Now, that's any installment that is handed over to you by the county tax collector and the assessor's office to be paid out in certain disbursements throughout the year. The second to last one would be property insurance, which is typically paid on an annual basis. And the last one is association. Now, it's not common for somebody to pay their association or homeowners association dues through their monthly mortgage payment, but it can be set up that way. So the next thing I want to talk about is, when is an impound account actually required? So an impound account would be required if a state or federal regulatory authority requires that loan mortgage has an impound. A loan mortgage account is also going to be required when that loan is guaranteed or insured by a state or federal government agency. Now, these agencies can include the VA, the Veteran Affairs. It could be a government-sponsored enterprise like Freddie Mac, or another FHA-related loan. An impound account may be required if the borrower misses 2 consecutive property tax installments. So that doesn't necessarily mean 2 years worth of payments, but just 2 consecutive installments. It'll also be required when the original principal amount of the loan is 90% more or 90% or more of either the sales price or the appraised value. If there are 2 or more mortgages against the property, and the value of those loans exceed 80% of the appraised value of the property, or if the mortgage loan is considered a higher price mortgage. A higher price mortgage is just a term that's used when a borrower qualifies for a higher mortgage, higher interest rate, or is required to pay more fees based on, the average price offer rate that's current on the market. The last reason would be if the current mortgage is actually modified through a lender's home preservation program. So if a property owner does fail to meet one of their obligations and they do happen to go into foreclosure, and maybe to save the home, the loan is modified, it's usually going to be a requirement, if they didn't have an impound account before, that they maintain one moving forward. Now, all those things do sound like a lot of different requirements and rules, but in reality, there's a lot of benefits to holding an impound account. In reality, it makes things simpler because property taxes are due in usually large lump sums twice a fiscal year. You don't have to worry about sort of saving that money and having it on time. On top of that, there's not going to be any need to keep track of due dates. The lender is going to be aware that property taxes are due twice every fiscal year. They're going to be aware that when your property insurance is set to renew, that those payments get sent out and the bills get paid. And again, just no large lump sum payments. Some people have difficulty saving money over time or maybe having access to it, but budgeting it into your monthly mortgage payment makes it a little bit easier when these due dates come up. Now, an escrow analysis is something that's performed initially when the account is opened. So it's going to be if you have it from the time that the loan originates, and then it's also going to take effect every year. Now, there are certain breakdowns and limits that the lender is going to go into when they do this analysis. It's completed once a year, like I mentioned. They're going to take your annual obligation and split them into 12 months. And that's really how they kind of come up with what you should pay every month. When you do set up the account the first time, they may require an initial deposit. And that's really due to the idea that they have to have a cushion. Okay. Now, the reason why it's split into 12 months is going to be because these things have to get paid on an annual or semi-annual basis, depending on what they are, going back to the PITIA. Now, the law does say that the most that they can require you to hold in addition to your monthly obligations is 2 months worth of a cushion, they call it. If at any time they do this escrow analysis and they figure out that your account is going to fall below that 2-month threshold, they will require an additional payment spread out either over 12 months or in one lump sum to make sure that they have enough money to pay the bills when they come due. Now, here's an example of a very, very simple escrow analysis. As you can see on the left side, if we were to just look at the year 2023, that fiscal year, and you look at the PITI, right? The principal, the interest, the property tax, and the insurance. If this individual's principal and their interest add up to about $1,400, the lender is going to look at their annual property taxes, and let's say it comes up to $2,500, and their annual insurance for the property is $500. If you were to split the property tax and the insurance into 12 equal payments, that equals about $250, moving their monthly payment to $1,650. Now that $250 is going to be there to be dispersed throughout the year to either the tax collector or the insurance company as the due dates come around. Now, moving forward in 2024, you can see that if the principal or the interest rate was fixed, the principal and the interest should not change. However, the lender may get notification, or they may project that the taxes will go up by about $100, and maybe the insurance may go up by $500 or by $25. So this moves the monthly obligation that the lender is required to collect for the escrow account to about $260.41. This moves the monthly payment up to $1,660.41. Now that change does come because the escrow analysis is going to make sure that the account does have enough money to pay the bills as they come through, so that you're usually going to get an explanation of this analysis once a year, once it's done. Now, an escrow analysis is going to be one way that you would notice a change in your monthly payment. There's a few other ways that you would notice a change in your monthly payment. One being if the lender force places home insurance on the property. Now, typically, if a property owner does set up an impound account and they shop for property insurance themselves, they may find that they've made a mistake in the actual amount of coverage that they're required to hold. If they do hold not enough coverage or no coverage when it comes to holding property insurance, the lender can in fact go out and purchase property insurance, which is usually going to be the most expensive one they find, and require that you pay it either back through your escrow account or all up front. Another thing that you may see a change or cause a change in your monthly payment is an increase in property taxes or your property insurance, just a regular increase. This increase could be because the the lender maybe didn't do their escrow analysis as accurately as they should have, or maybe they did the taxes came up and you had another assessment or an escaped assessment, and the county sort of just notified your lender that you owe more money. Now, property taxes are due in 2 installments each fiscal year, the first being November 10th, the second being by February 10th. Now, these 2 payments can be paid all at once, but the very first installment would be due on the 10th of November. Property insurance is paid annually, so that disbursement should happen no more than 1 time a year. Now, another change in your monthly payment that you may notice is if you have an adjustable rate mortgage. Now, the previous screen, when we looked at the fixed rate mortgage, the principal and the interest didn't change, but the property taxes and the property insurance changed. But if you have an adjustable rate mortgage, all 4 of those things can change throughout the life of the loan. The other thing that you might see is a disbursement error. It could be possible that there was some sort of clerical error and your lender sent out either too much money or not enough to the tax collector or to your property insurance. And that's something that it can happen and needs to be addressed as soon as the escrow analysis comes out. Another thing, if you do hold your homeowners association in your impound account, a special assessment or an emergency assessment by your association can affect your monthly payment, especially if the lender is notified and they do make that disbursement as requested. Now, all of these things, if they should happen, it is important to understand where to get assistance. Our department, like I mentioned in the beginning, does have a foreclosure prevention service that is actually free. Our service is designed to help property owners not only navigate the foreclosure process, but explore any and all options that might be available to them to avoid foreclosure. We're here really to open a dialogue between property owners and mortgage lenders to ensure that the property owner is reviewed for assistance properly. We're here to provide guidance and understanding when mortgage lenders provide these options to the property owners. Just because a lender is offering you, a loan modification or a repayment plan does not necessarily mean that that might be the best fit for you. We do provide individual attention between a foreclosure prevention counselor and the property owner to discuss the property owner's unique situation. Everybody's situation when it comes to home ownership and then preventing foreclosure is different. So we are very specialized in, understanding just the wide variety of roads that this map of foreclosure can provide. Now, one other important thing that I wanted to bring up is currently California does have a mortgage relief fund that was set up by the federal government here in our own state. It was established to mitigate financial hardships associated with the coronavirus. Certain property owners that are eligible could receive potentially up to $80,000 in mortgage relief. This money does not have to be repaid, which makes this program very unique. And that is again only related to mortgage delinquencies. Additionally, they are able to provide $20,000 of property tax relief if a property owner who was affected by the coronavirus, wasn't able to pay their property taxes, but they didn't have a loan against the property, so they would be able to take advantage of that. We encourage you, if you do have questions about that program, because we do not administer it, to reach out to them directly. The telephone number is 888-840-2594. I know that they do require you to apply for the assistance or do the initial questionnaire online. You can reach them at camortgagerelief.org. Now, when it comes to contacting our department directly, or more specifically our unit, we are located at the LA County Hall of Records. We are at 320 West Temple Street in room G10, the city of Los Angeles, zip code 90012. You could email us directly at homehelp@dcba.lacounty.gov. You could call us directly at 833-238-4450. And our office hours are 8:30 to 4:30. So if you wanted to come in, you could set up an appointment on our website or feel more than welcome to just come in.